And then the other thing that we're going to do, we're going to answer.
We're going to cover the top 25 questions about first-time home buyer mortgages.
Yeah, and the rules are different.
Yeah.
And just like we said a few minutes ago, some of these things are going to be things that, depending upon where you got our information and how you got onto this workshop today. Certainly, if you're working with us, this is some of this information you already have.
That's correct.
But some of this information we're going to give you if you're working with another lender, they might not want you to know what you're getting ready to find out on this.
There's a whole sea of things out there that you really need to be plugged into to know exactly what your options are.
Well, Ralph, the first question comes upon, let's just do a basic here. What exactly is a mortgage?
What's a mortgage? Works this way. When you buy a house and you borrow money to buy that house, you have a note. A note is simply a promise to pay. Okay? Now, the promise to pay is all well and good, but the lender wants to know what happens if you don't pay.
Yeah,
not because you stiffed me on purpose, but something happened and now I'm not getting my payments. They need to have security. So what they do is they put a lien against the property. And the lien against the property, they tie to that note. So if you don't make the payments on your note, then they can take action against that lien. That lien is the mortgage.
So in English, what that means is the note, which is one of the papers they'll sign at closing,
correct,
is the IOU.
That's right. And the
mortgage
ties the note to the property.
Is the collateral.
That's correct.
Okay, very good. Now, are there special mortgages for first-time home buyers?
Yes, there are.
Yeah, there are.
They have them designed just for people who haven't bought houses before.
Yeah, and there's some very good 100% financing still available too.
100%.
Little known secret, there's some government programs, 100% financing. Again, the number right down beneath there, just call our office and we can give you some of the information about those 100% financing. And those aren't smoke and mirror type loans or buy here, pay here type stuff.
Oh no, this is straight up real deals, real lenders.
Government programs.
Government programs.
Absolutely.
Okay, so what steps are needed to be taken in order to secure a loan? Well, first thing you're going to do is you're going to fill out an application.
Now, once I fill out that application, what do I need to provide?
Okay, you're going to have several things that come along with it. And this is a common list that you should just plan on. First of all, you're going to need year-to-date pay stubs for the last 2 to 3 months.
Yeah, no question.
Okay? You're going to need your W-2s for the last 2 years. And you're going to need the complete tax return if you're self-employed.
Or 1099 employee.
Or 1099 employee. Okay? You're going to need information on your long-term debts.
In other words, your car payments, credit card payments,
things
like that.
Okay? Recent bank statements for your checking account, your savings account, 401ks, anything like that. You're going to need, here we do have tax returns for the past 2 years.
Yep.
Okay? Proof of any other income.
So let's say you get income, say child support or alimony or maybe some sort of a death benefit or you won the Illinois State Lottery some years ago. You're
having some annuity payments that come into you. Anything like that. You'll just need to be able to prove that. You'll also need the address and the description of the property that you're going to buy. Okay? Obviously, you'll need the sales contract.
Yeah.
And then
if you've been renting, they go, well, how do we know that we see that you make your car payment? How do we know that you're going to make your rent payment? So they're going to want to look at a 12-month rental
verification of rent.
Absolutely.
That's right. Okay, so how are pre-qualifying and pre-approval different? This is a great question because there's a lot of misunderstanding here.
So I want everybody on a piece of paper right now, write down pre-qualify and then write down pre-approval. And you're going to write kind of like a little list here. So
first of all, pre-qualification is informal. It can be done generally over the phone. You can speak to a person, they'll gather some information, and they'll give you a quick pre-qualification. Okay? You're not obligated when you have you
haven't signed anything.
There's nothing to sign. You haven't done any paperwork. And not only that, the figures that they give you will be ballpark numbers. They're going to be general numbers, and you won't, like they can't hold you to it because you're not obligated. Frankly, you can't hold them either. It's an informal conversation.
In other words, when somebody calls in on a pre-qualification and say, well, how much do you make? I make around this much. That's good enough for pre-qualifying.
That's right. Assuming that that's correct, then this will work.
Yeah. Now, we strongly recommend that's not what you do.
Correct.
Here's what you do instead.
What you really should do is get a pre-approval. And the pre-approval is a lender's commitment to lend to you.
And the way they can lend to you is they collect the items that we listed earlier. They've looked at your pay stub. They looked at your tax returns. They've looked at your contract. They've looked at all these things.
All that's been verified.
All that's been verified. That's what a pre-approval is. And it gives you, instead of a ballpark figure, this is a definite idea of what you can afford.
And let me tell you, you're much more attractive to a seller if you come in with a pre-approval than if you simply have a pre-qualification.
Frankly, most real estate agents wouldn't even accept an offer with just a pre-qualification.
Correct.
So make sure, what you want to...
Too subjective.
So where you see the pre-approval there, I want you to kind of circle that and put a star. That's what you want. If you have not been pre-approved yet, by the way, just scroll down there. You see our contact information. You can call us right now. It takes about 5 or 10 minutes to start the process.
Absolutely. So what is the credit bureau score, and how do lenders use them?
Well, so what's the range of credit scores, Ralph?
The credit scores actually range all the way down to 300 and all the way up to 850.
And as we can see there, the largest percentage of the population has, the biggest single group is there in the 750 range. Now, the take-home message here is, the lower the credit score, the more challenging it is.
Correct.
The take-home message we want you guys to take home today is that you do have options available for you to buy a home if you have less than perfect credit. This is definitely an area that we can help you with. There are programs for you, and we can help you with that. Again, simply look at the phone number down there, give us a call, and we can give you a great insider report. We got a report, it's called the 10 Myths that the credit bureaus will never tell you.
That's right.
And it is a killer report.
It really is eye-opening.
Yeah,
it's great.
So give that a call.
Okay, how can I find out information about my own credit history?
Well, there's 3 bureaus. The first one is Equifax, Experian, and TransUnion. The easiest way to find out, Ralph, is
just call us for a copy of your report. We can help you out with it.
Absolutely. We'll be happy to do that for you. And by the way, do not fall for these online free credit report things. Yeah, 2 reasons. Number 1, some of them are actually scams where they're just they're getting your name, your social security number.
You're giving them all your personal information.
Identity theft.
Ouch.
Yeah, absolutely.
Yeah.
The other thing is, most of these programs, virtually all of them, they're actually selling you a service where they're going to be checking your credit report every so often. It's kind of in the fine print, so you're actually paying for something that you didn't know you're buying.
You're paying for somebody to check your credit, and every time they do, it drops your score.
And they're charging you to do it.
And they're charging you to do it.
So do not do the free online ones. Give us a call, and we can help you with that.
Absolutely. Okay. How do I choose the best loan program for me?
Well, ask yourself 3 questions.
Here's the questions. First, do you expect your finances to change over the next few years? Okay,
Yep.
That's number 1.
Like if you just got out of school and you expect your income to go up, or let's say you're getting ready to retire. And maybe your income is going to drop 25%.
Correct.
You need to kind of keep that in mind
That's
also.
definitely got to be part of your figure. Okay. Are you planning to live in this home for a long period of time?
In other words, if you're going to be there for a long period, a fixed rate is definitely the thing one you want to do. If you're going to be there only for a year or 2, well, maybe an adjustable mortgage, perhaps some of those would be
and
worth looking at.
sometimes you can get fixed for a certain period and it becomes adjustable, and the period, and it's a lower rate during the time it's fixed than if you took a full 30 years.
Of course, the big question is are you comfortable with the idea of a changing mortgage amount? If you're not, make sure you get the fixed rate.
You want to go with a fixed rate. You want to go with a fixed rate.
And do you wish to be free of mortgage debt as your children approach college age or as you prepare for retirement? In other words, when you're doing a mortgage, there is some long-term planning that's necessary here.
That's right.
And the key to doing this is to be very brutally honest with yourself.
That's right. Now, see, you can take a 30-year mortgage, but using just some real simple little tricks that most people aren't aware of, you can cut 10 years, 15 years off that mortgage, and really not have much more of a payment.
That's exactly right.
And so it's really, there's a lot to know about that.
So let's talk about some pros and cons of some of the different mortgages, Ralph.
Okay. First of all, we'll tackle the fixed rate.
All right. What's one good thing about the fixed rate?
Well, it's predictable.
Yeah.
You know exactly what the payment is going to be. Why? Because it's fixed. Your rate and your payment stay the same for the term of the loan.
And typically, fixed rate mortgages are either 15 years or 30 years.
Or 30 years.
Now, one thing we want you guys to keep in mind here is you can always take a 30-year mortgage and pay it off in 15 years. In other words, if you have a 30-year mortgage and you pay as if it's a 15-year mortgage,
you make the payment that it would have been if it were 15 years.
Well, it's paid off in 15 years.
It's paid off in 15 years.
However, if you take a 15-year mortgage and try to pay it off in 30,
that doesn't work so well.
They call that foreclosure.
That's exactly right.
Yeah, so just kind of keep that in mind.
Okay. The next big type is your adjustable rate mortgage or your ARM.
Now, I can tell you, these have definitely lost favor here in the last couple of years, and frankly, with rates as low as they are right now, we're not here to tell you what's right and wrong for you because we don't know you necessarily.
And don't know your situation.
Yeah, and so give us a call, and that's where we can help you look at these things. However, the adjustable rates, while the rate might be lower to begin with, is they do increase or decrease on a regular schedule with interest. They do have interest rate changes, even though they start typically
generally lower than a fixed rate.
Somewhat lower.
Somewhat lower.
And thus?
You have lower monthly payments.
Yeah. Now, another clever little program is what we call the Easy Start program.
This is great.
This is very interesting. Yeah. Now, the Easy Start, and we have a whole nother workshop on that. In fact, we strongly recommend call the office, get the schedule of the Easy Start workshop that we're having.
That's a great workshop to attend.
You don't want to miss that one because I guarantee you're not going to hear that anywhere else. It's a little-known program.
Right.
And what it does is it's not an adjustable mortgage. Your interest rate for the entire first year is 2% less than what's the standard rate.
And it's fixed at that rate.
And it's fixed at that rate. The next year, it's 1% less.
Yes.
And then the third year, it's
a regular fixed rate.
It's a regular fixed rate.
Yes.
And all those numbers are locked in at closing, so it's not adjustable.
Yeah. It's not that it's an adjustable where you start and you have a normal rate that goes up the second year and up the third year to some higher thing. Your rate is set, and you're getting a discount
on year one
and a discount on year two.
Yeah, and the discount's remarkable. I mean,
it's staggering when you look at the interest savings.
Yeah, so definitely call in and take a look at that one. And then there's the balloon mortgages. And explain what a balloon mortgage is.
A balloon mortgage is a payment that has a 30-year fixed rate, but it becomes due and payable at the end of a shorter time frame, like the 5 years or 7 years or 10 years. And so whatever the balance is at that time, it's due and payable.
Yeah. Well, and again, we're not, today's not the day to discuss which of these is best for you. Call the office, but make sure you ask about the Easy Start. Very clever little program.
Absolutely.
So when do ARMs or adjustable rate mortgages make sense, Ralph?
Well, first of all, if you're expecting an increase in income,
like you're getting ready to graduate school, or maybe your spouse is, or maybe you're in the military, just say.
That's correct.
And you're expecting pay raises as
you expect to be making more money here
as you put stripes on your shoulder.
That's right.
Yeah.
And the other thing is, if you have a short-term purchase.
So in other words, if I'm on a 2-year ARM and I'm only going to be there for 2 years.
Right.
Why not?
Why not?
Very good.
Okay.
All right, so Ralph, what are the advantages of a 15 versus a 30-year term? Let's talk about that a little bit.
Well, first of all, let's talk about the principal.
Okay.
On the 15, you're actually going to be paying more principal, and so it will pay off sooner.
Now, what is principal?
Principal is the actual amount that you borrowed. So if you borrowed $100,000, well, the principal is $100,000. On a 30-year fixed loan, you'll pay for that house 2 or 3 times because of all the interest that you pay.
So on a 15-year, I have a higher payment, but it's because I'm paying off the principal or paying off the loan of the house.
That's exactly right, and you'll have a huge interest savings over that.
So even though my interest rate might be lower on a 15-year, well, not only the rate lower, I'm going to be paying less interest because I borrowed the money for a less period of time.
That's exactly right.
So I'll pay less interest.
Okay, now on a 30-year, you get a larger tax deduction.
Because I'm paying more in interest.
Because you're paying more.
Okay.
So
okay.
that kind of goes hand in hand. On the 15-year, the loan is usually made at a lower interest rate. You're building equity faster because early payments pay more principal.
Okay, so I think the key here, and again, we can help you do this, is you look at this and you go, well, gee, the 15 years is a no-brainer as long as you can afford it.
That's right.
And so we recommend that you call our office and we'll go over these and we'll crunch the numbers.
Again, if you take a 30-year mortgage and you make 15-year payments, it'll pay off in 15 years. But if you find yourself tight in a certain month or something like that, well, that month you could go back and pay the regular 30-year payment.
Absolutely.
So you've got a lot more flexibility.
But Ralph, what if I get a 30-year mortgage and then I see that interest rates have decreased and I'm on a fixed rate loan? In other words, I was protected at that price, but frankly, rates, maybe they went down. Well, what can I do?
Well, first thing you do is want to take a look at refinancing the loan.
So you can refinance the loan.
See what your choices are. You can, and basically refinancing just means that they rewrite the loan at the lower interest rate.
Okay, so again, you could just call the office and we can help you with refinancing.
Help you with that. All right. Discount point. What are discount points?
So discount points allows you to lower your interest rate. In other words, it actually helps buy down the rate. Now, one thing that I've noticed sometimes in people's marketing is, they might say, we never charge points.
Right.
Well, that's kind of a buzzword on advertising, but truth be known, sometimes it's in your best interest to pay points, and frankly, sometimes it's not.
Correct.
Well, the downside of paying points, of course, is there are some costs involved. However, typically, the amount it costs you to buy down the rate, typically somewhere around 5 years, the amount you've saved in interest covers the cost of buying those discount points.
Exactly. So, said that another way, if you don't plan to stay in a house 5 years,
It's probably not a good idea.
probably it's not a good idea. And by the way, when we talk about points, a point is 1%.
So on a $100,000 house,
That's $1,000.
right? So that $1,000 lowers my interest rate, which lowers my payment, and typically it takes about 5 years to save that $1,000. Typically,
That's right.
rule of thumb. So if I'm going to be there for 30 years, well, for 25 years, I'm going to be ahead of the game.
That's exactly right.
So don't, anytime somebody says,
Well, you should never pay points.
that may or may not be the case.
That may or may not be the case.
Again, so give us a call and we can crunch these numbers for your situation.
And if you do pay them, by the way, they are tax deductible on the home purchase.
That's exactly right.
Okay? Okay, what's included in a monthly mortgage payment? A lot of time you hear the terms PITI.
All right.
So let's talk about that. P is the principal.
Which is,
That's the actual amount of money that you borrowed.
okay,
I is the interest. That's the interest that you're paying on the money that you borrowed.
okay,
Taxes, the real estate taxes. That's what you pay to your county each year.
okay.
And then homeowners insurance is the other I generally.
In case the house burns down.
In case the house, that's hazard insurance
Okay.
is the buzzword there. So PITI. And then the other type of insurance that you'll most likely see, depending on how much you borrow, is mortgage insurance.
Now, one thing to keep in mind about mortgage insurance does not insure the home.
Correct.
The mortgage insurance insures the lender. In other words, if you stop making payments or if somebody stops making payments, the lender has an insurance policy that helps cover the loss. So, the take-home message here is mortgage insurance may or may not be necessary for the particular loan that you're getting.
It's actually a premium that you pay to help them.
Exactly.
You don't get the benefit of it. So, and normally what happens is if you put down 20% or more on your purchase, mortgage insurance is not required.
Exactly.
Generally, if you put down less than 20%, it is required.
Yes.
Okay.
Except with VA loans.
Except with a VA, yeah, a government loan is different,
Again, this is not the.
which is why you need to call us.
Yeah, you need to call us because there's a lot of. I'm sitting here. There's a lot of other. We could make this presentation 2 days long.
Correct.
Because there's a lot of
There's a
information.
lot,
So
right.
we're just covering general
We're kind of
information.
moving through here.
The idea is for us to generate questions that you write down and then you call us.
We want you to think about
Yeah,
that.
and then call the office.
Okay, so what's an escrow account and do I need one?
What is an escrow account?
An escrow account is an account that's established by your lender to pay for your taxes and insurance from your monthly mortgage payment.
So in other words, if my payment's $1,000, just for easy math.
PITI is $1,000, principal, interest, tax, insurance. But let's say your principal and interest is only $800,
Okay.
just for simple math.
Okay.
And the $200 is for taxes and insurance.
Okay.
They'll take that $200 and stick it in an escrow account.
Like a bank account.
A bank account.
With my name on it,
With
so to
your
speak.
name for this mortgage. And that will accrue $200 every month.
Mm-hmm.
Well, at the end of 12 months, you'd have $2,400 that's sitting there now for you to pay your taxes and your insurance next year.
So in other words, the escrow account is where part of my monthly mortgage payment goes.
Yes.
To cover my taxes and insurance.
It's a savings account for you on your mortgage.
And then at the end of the year, so to speak, they take that money and then they pay my tax and insurance for me.
That's correct. Now,
Okay.
sometimes they're optional.
Okay.
And again, that typically has to do with how much money you're borrowing on your purchase.
So you
as
just
a
give us a call.
percentage.
Yeah.
Just call us and we can help you with that.
Now this is a real broad brush we're getting ready to give you here. Programs are changing literally daily in today's market.
Yes.
And we just want you to let you know that there are still 100% programs available that are extremely attractive.
Absolutely.
But just as a general sense, we're looking at somewhere around 5% down,
5% down.
10% down, and
Correct.
0. So how much money of a down payment do you need? Well, you need to call the office for that one.
There's a lot of factors that
Yes.
depends on.
Yeah.
Okay, so
But
give
in
us a
addition
call.
to that, Ralph, What else do we need?
Well, you have closing costs that are over and above the down payment.
And what do you mean by closing costs?
Well, closing costs are going to be, for instance, dock stamps.
Taxes, title insurance.
Okay.
Maybe a home inspector,
an appraisal.
Okay.
A survey.
Okay.
These are all costs associated with purchasing the home. Homeowners insurance, of course, which is a requirement from the lender.
Okay.
We just kind of hit on some inspections.
Okay.
If there's repairs to be done, well, these would all be taken into account.
Now, one thing that your take-home message on this particular slide that we're showing you here is for you to call the office, because we don't want you to look at this and get scared away, because there are programs available where the seller can help you pay these things. And so there's other third parties that can help cover some of these expenses.
There are some available where the seller is required to help you pay some of these things.
No question.
Yeah.
So again, time permitting, we can't talk about all the different programs right here. We just want you to know these are things to consider.
Absolutely.
And there's very little known secrets about how to get other people to pay these things, and that's why you want to call the office.
Correct. Okay. What's the loan to value, LTV? How does it determine the size of my loan? Well, basically, it's a ratio, a loan to value. That's the amount of the loan compared to the value of the property. So again, for simple math,
okay,
on a $100,000 house,
okay,
if you borrow $80,000,
okay,
your loan is $80,000 on a value of 100. Your loan to value is 80%.
So in other words, if we look at this loan to value, right where it says loan to value would be 80, and mortgage amount would be 80,000.
80,000.
And appraised value of the property would be 100,000.
Would be 100,000.
So I have an 80 loan to value.
That's right.
Anyway, we just wanted you to know this one. You might hear this term kind of tossed around. That's what they're talking
now
about.
You know.
Yeah.
Okay. What makes up closing costs? Now we touched on this a second ago, but we'll just kind of run through here.
And again, these may or may not apply to your particular situation.
It's not an exhaustive list. You may have not all of these, or you may have more than these.
Exactly, but this is just a general list.
Correct. So the first thing you see here, attorneys or escrow fees, property taxes to cover the tax period up to the time you bought it, the interest, a loan origination fee if you have one of those, recording fees to record your documents after the closing.
Survey.
Survey.
But again, if you're in a condo, you don't need a survey. So, again,
right.
these aren't going to apply to everybody.
Not everything applies everywhere. The first premium of mortgage insurance, if it's applicable. Your title insurance, and there's two kinds. There's buyer's title and there's lender's title.
Yeah.
Okay. Loan discount points, the first 2 to 3 months payments of the escrow for taxes and insurance, a paid receipt for the homeowner's insurance. Okay. Any documentation preparation fees the lender may charge, a third-party appraisal fee.
So the take-home message in looking at all those is, again, these may or may not apply to your particular situation, and there's very clever little ninja ways to have other people cover these costs for you.
And again, to find those, you just give us a call.
Give us a call, and we'll find out about your particular situation and what programs are available for you.
Right. Okay. So now, what are your responsibilities during the lending process? And we'll kind of move right through these. You need to be sure and read and understand everything before you sign it.
Yeah, absolutely.
When it comes to the application. Okay.
Never,
if something is not clear, ask.
We're here to help you with that.
Exactly. Refuse to sign blank documents.
And you know what? Let's tell you something right now. One of the services that we provide is if you're already working with another lender and they ask you something or they're asking you to sign something, look, we'll be your own personal watchdog. And this can be our little secret. You call us, show us what they're asking you to sign. You can fax it, you can email it over to you. We'll be happy to meet with you.
We'll just tell you if you're being treated fairly.
Yeah, that's all.
Yep.
So we'll be a little watchdog too. But refuse to sign any blank documents.
You don't buy property for someone else.
No question. Buy for you.
Buy it for yourself. Don't overstate your income.
Yeah.
There's a word for that. Well, 2, mortgage fraud.
Yeah.
And that can come back to bite you later. You don't want to mess around with that. Don't overstate how long you've been employed. This all has to do with being honest.
Just being honest
on your application,
especially in today's market.
Right.
They look at things with a
jaundiced eye.
Yeah, a jaundiced eye. So you want to make sure that everything's above board.
Don't overestimate or overstate your assets. Okay. Accurately report your debts. Don't leave anything out. Don't change your income tax returns for any reason.
Absolutely.
Okay. Tell the whole truth about any gifts you're receiving. Don't list fake co-borrowers. Oh my gosh.
And guys, this is for your protection on some of these.
Yeah, absolutely.
Yeah.
And now look, when stuff like this we're mentioning, if everything goes fine, It's not an issue. But let me tell you, the first time something doesn't happen right, and the lender finds out that they made the loan based on false information you gave them,
It's not good.
it's not good. You got a real problem.
It's not good.
So you be truthful about your credit problems, past and present. Be honest about your intention to occupy the home. Is it going to be an investment home, or are you going to live there? Don't provide false supporting documents.
So the bottom line on all this is it's best if you have some issues or a situation, just simply give us a call and talk to us about it. Let us know what your situation is, because there is almost no situation that we can't find a solution for.
And let me tell you, you can't shock us.
No, that's...
You're not going to tell us something we haven't heard
Yeah.
or show us something we haven't seen.
And trust us, we understand that in today's economy, things have been tough for some people.
Yes.
And we just want you to know that it's not your fault.
Right.
There's help available. And give us a call. If you have credit issues, again, we have a whole nother workshop on that. There are definitely some answers for that. Having credit issues is never a reason not to buy a house.
That's correct.
Okay.
Okay.
Just real quick, Ralph, what exactly, and again, we might hear this term a little bit, just kind of real quickly, what is RESPA?
RESPA, you can see right here, the Real Estate Settlement and Procedures Act. It actually is an act of Congress that governs how closings work on real estate transactions. It protects you as a borrower from lending abuses.
And so the bottom line is all costs associated with the loan and buying a house must be fully disclosed with you. And if the if the lender and the real estate agent are related, certainly nothing wrong with that.
That's right.
They just have to disclose.
It's got to disclose we got a relationship.
That's exactly right. Nothing wrong with the relationship, but you need to know them.
That's exactly right.
Okay.
Okay. So what happens after I've applied for the loan?
Okay, good question. Typically, in today's market, to actually close on the loan once you have a property is going to be between 4 and 6 weeks. Now, I'm going to tell you, we've seen it in extraordinary situation happening in substantially less time than that.
Yes.
And we've seen it happen substantially longer than that.
Substantially longer. The thing is, years ago, just the approval process took a long time. Now, for most loan types, these are underwritten by computers, and honestly, you can have a real approval back in minutes.
Yeah.
And so then the rest of that is getting items together, supporting documents, and get to the closing table.
Now, here's the big deal: is when your real estate agent or your lender asks you for something, they're not asking you because they want to be hard on you or anything. They're asking you
or being nosy.
Or being nosy. They're asking because the underwriter or the person that actually loans the money or the government agency that evaluates the loan is asking for it.
Correct.
And we can't say, well, it's going to be inconvenient for them to do that. It doesn't matter.
Then it's going to be inconvenient for them to lend you money.
Yeah, that's exactly right. So keep in mind that we're on your team. We got your back. We're not the bad guy. We're the good guy.
Oh no, we're definitely in your batter's box.
No question about it. And we're there to help you. So I can't overemphasize. Use our resources. Help me help you.
Absolutely.
That's what this does.
Okay, so the loan gets approved, and then you schedule a closing date.
Very good.
Okay. So what should we be looking out for during the final walkthrough?
What is a final walkthrough?
The final walkthrough is your loan's approved, your closing is scheduled. In fact, if it's in the afternoon, you might have the final walkthrough of the property the morning before you go to closing or immediately before you go to the closing table. You actually go to the property and walk through the house to see it in its final state before you take ownership.
In other words, you're making sure that the kitchen sink is still there.
It's still there. Did somebody come and swipe my cabinets?
Yeah. Is there?
Or the contract said the fridge is going to be here. Is it here?
Yeah.
See?
Or something was going to be fixed. Was it fixed?
Something was going to be fixed.
So what do you do, Ralph?
You examine every corner of the empty house. It's way easier to look at it before you put a bunch of furniture in it. Okay? Check floor to ceiling. Be sure the seller fixed any problems that were promised, and be sure everything is perfect before you close.
Oh, but we'll take care of that after closing, Ralph.
Yeah. Boop. Hey, hold on, Pinocchio.
Yeah, talk to the hand.
Exactly. You want it done before you close. And look, that may ruffle some feathers. Somebody might go, oh, for crying out loud, you can trust me, I'll take care of it. Look, I do trust you.
Yeah.
Let's fix it now. That way trust doesn't even come into the picture.
Exactly.
Okay?
Absolutely.
All right. What can I expect to happen on closing day?
All right. Well, now sometimes your insurance has to be paid ahead of time, so you may have already paid that. If you haven't, you'll be bringing your first year of insurance onto the closing date.
Yep.
Now the other thing is, Ralph, do I just bring my checkbook and write a check for the balance?
You cannot bring a personal check. You must bring a cashier's check for the money that you're putting down on the property. It must be basically, it's certified funds.
Okay.
I'd almost say bring cash, but that's hard to deal with.
Yeah.
You want certified funds, which means they know that the check is guaranteed and can't bounce.
Okay, and what else do I need?
You'll get proof of your inspections or your warranties.
So in other words, I actually want to see these things.
You actually want to see them. You don't just want to hear that they exist.
So then what do I do?
Frankly, you're gonna sign the documents
Okay.
on the dotted line. Okay, the mortgage note, the note, the mortgage, and the deed of trust. Depending on what state you live in, these all have different names.
Okay.
Okay, so
And then now we have a binding sales
a
contract.
binding sales contract.
And then what I go home with?
You go home with the keys.
Well, that's pretty cool.
Absolutely.
Couple last questions, Ralph. Can I pay off my loan ahead of schedule?
Absolutely, you can.
Yeah.
Now, just be aware that certain lenders will give you better terms on the front end if you'll accept some sort of a prepayment penalty.
So in other words, just check with the lender to see are there any prepayment penalties.
That's
They're-
right.
They're certainly less popular today than they have been. But
than they
again,
used to be.
This is not we don't have time here to discuss the pros and cons of it.
Yeah.
If you want some information about that, just simply call the office.
That's right. We'll be glad to help.
And we'll be glad to talk about that. Wait. Stop the presses here, Ralph.
Yeah.
You're holding out on us. The beginning of this presentation, it said there was 25 questions.
That's correct.
I've been sitting here counting.
Yes.
I only counted 23. Where's the other 2 questions?
Well, see, Carl, that's because I've got 2 questions for you.
Okay. So what's
Okay.
those 2 questions?
The 2 questions are, what are the 10 questions a person must ask their home inspector before deciding to buy a house? Okay? That's one question.
Okay.
And the other one is, what's the best way to negotiate my contract? What do I need to know on the front end before I sign a contract?
So guys, what we have here at the mortgage company, we have 2 reports that you absolutely positively must have in your hand. Time does not permit us to go over them here.
That's right.
Number 1 is the 10 things you must ask your home inspector in today's market. We're going to give this to you.
Free to you.
For you. The second thing is we have a report that talks about mastering negotiation on houses. Frankly, not just for houses, but for cars.
For life.
For your
your
kids.
kids.
Yeah.
I'm telling you what, it's a free report and it is great information.
Yeah.
And again, we want to give it to you. To get it, just give us a call.
Give us a call and we'll ship it out to you. We can email it to you. So just let us know that you want it. No matter what you're doing, no matter when you're doing it, get these right now while you're thinking about it.
Yes.
Because time will go on, you'll forget about it. And trust me, when you see these things, you're going to be glad that you have them. And again, we're not selling them to you. It's our gift to you.
Absolutely.
Yeah. So
Boy,
there's
this is great information here.
when should they call, Ralph?
They should call right now.
Yeah. Why are you still listening to this?
Immediately.
That's right.
Yes. Do not delay. Do not pass go. Do not collect $200.
And so call in and ask, speak to the loan officer. They'll be able to help you with this. Great information that you need to know to avoid getting ripped off and buying a house in today's market.
Absolutely.
Yeah, great stuff. So we honor the time that you spent with us today. We also have some other great workshops that we're planning, so call the office, get
Give
a
us a
schedule.
call and we can give you a schedule of things that are coming up. There's a ton of great information. This is an excellent resource for you in this process.
Yeah, and it's free.
Absolutely free.
Yeah, so call the office,
Thanks
get
a
your free
lot.
reports, and we'll talk to you when you call in.